If you follow the markets, you know the feeling, right? Every single day, it's a fire hose of information, headlines, and volatility. Trying to find a clear signal in all that noise can feel just about impossible. So today, we're going to explore a specific strategy that's designed to do exactly that. I mean, we see headlines like this all the time. One speech, one single data point, and boom, the entire market shifts. This constant churn is exactly the kind of short-term noise that makes investing feel like a total guessing game. And, it raises a really fundamental question for anyone trying to build long-term wealth. And this is the question, isn't it? It's at the heart of everything. Is there some systematic way to do better than just average, or is it all just random luck? This isn't just a practical question, it's a deep theoretical one, and the search for an answer leads us straight to a core academic concept. And that concept is the efficient market hypothesis. The basic idea here is that the market is just so good, so fast at processing information that a stock's current price is pretty much its correct price. If that's true, then finding an undervalued stock is, well, nearly impossible. But there's a key distinction that we really need to make.
It all comes down to the difference between market value and intrinsic value. Market value, that's what you see on your screen right now. It's the price, and it's swayed by all that news and sentiment. But intrinsic value, that's the true worth of a company, based on its real financial health and its long-term potential. Now, when markets are efficient, these two are super close. But when they pull apart, well, that's where an opportunity might just appear.
So this is the big challenge, right? If the market is so darn efficient, are there any systematic ways to find that edge? How do we get beyond just picking individual stocks and, hoping for the best?
Well, one answer is something called factor investing. Instead of just looking at companies one by one, this strategy zooms in on specific, measurable characteristics or factors that have historically, over time, been linked to higher returns. It's a way of deliberately tilting your portfolio toward these proven drivers of performance.
So what are these factors we're talking about? Well, there are quite a few, but we're going to focus on 4 of the big ones, the most widely researched drivers of return. You can think of them as different lenses for viewing the market: growth, value, size, and quality. So let's break each one down. First up, we've got growth. This is all about finding tomorrow's winners. We're talking about companies that are expanding like crazy, often because they're disrupting old industries or even creating totally new ones. Investors are willing to pay a premium for these because they're betting on big profits way down the road. So to find these companies, you're looking at things on the cutting edge. Think AI innovators or biotech breakthroughs. But of course, there's a catch. Because so much of their value is tied to profits way out in the future, growth stocks can be super volatile. They can get hit really hard when interest rates start to decline. Next, we have basically the polar opposite of growth: value investing. If growth is about buying tomorrow's superstars, value is about buying today's bargains. The whole goal here is to find solid companies that the market has, for some temporary reason, unfairly punished or just completely overlooked. Value investors are kind of like detectives. They're searching for companies that are trading at a discount using metrics like a low price-to-earnings ratio. And this strategy can do particularly well in environments with rising interest rates or inflation, because that's when investors tend to shift away from speculation and toward more tangible, right-now earnings. Okay, our third factor is size. The idea here is actually pretty simple, but it's backed up by decades of data. Over the long run, smaller companies have historically delivered higher returns than their bigger, more established counterparts. So what's the logic here? Well, smaller companies just have more room to grow. They're often more nimble, they can innovate faster, and because they get less attention from Wall Street, there's a much better chance of discovering a true hidden gem. Of course, the trade-off, as you might guess, is higher risk and a lot more volatility. And finally, we have quality. This factor isn't about finding the fastest grown stock or the absolute cheapest one. Nope. It's about finding the best companies, the ones with rock-solid financials, durable competitive advantages, and just excellent management teams. These are the companies built to last. You can identify these companies by looking for things like stable earnings, low debt, and high profitability. In really turbulent times, like with all the economic uncertainty we see today, these quality companies can act as a stabilizing force in a portfolio, providing reliable performance when other, more speculative bets start to fall apart. Okay, so let's pull this all together. When you look at these 4 factors side by side, you can really see how each one has a distinct role to play.
You've got growth for those times of rapid innovation, value for inflationary periods, size when the economy is bouncing back, and quality for those uncertain times. It's a pretty powerful framework for thinking about portfolio construction.
But here is the single most important takeaway from all of this. There is no magic bullet, not a single one. Leadership rotates. The growth stocks that are soaring one year can easily lag the next, while those out-of-favor value stocks might suddenly have their moment in the sun. Relying on just one factor is a very, very risky bet. And this leads to the ultimate takeaway. The real power here isn't in trying to guess the right factor for the next 12 months. No way. It's about building a resilient portfolio through thoughtful diversification across multiple factors and combining that with a genuinely long-term perspective. So this brings the question right back to you and your own portfolio, because whether you realized it or not, you already have exposure to these factors. Are you maybe heavily tilted towards those high-flying growth stocks, or are you concentrated in large, quality companies? Just understanding these underlying drivers is the absolute first step toward building a more resilient and, frankly, a more intentional strategy.